Hey, what's going on? This is Andrew from www.einvestingforbeginners.com. Got another video for you today to show you how to calculate price to book or PB ratio. It's the standard valuation used in value investing strategies, and I'm going to show you how to calculate it. It's a great ratio to figure out whether a company is undervalued or overvalued because, to start, it's a little bit more reliable than the PE ratio, price to earnings ratio, because price to earnings can be manipulated pretty easily by companies. They can do it both legally and illegally. They can manipulate their earnings. Some things they do legally are they have like different accounting tricks, and they also do things like buying back shares, lower the share count to up the earnings per share numbers, and that's another way they can manipulate price to earnings ratio. Whereas PB ratio can't be manipulated as easily. It's more consistent, and it's really just a better indicator of whether a stock is undervalued or overvalued, and can lead you to some greater returns. It's been popularized by guys like Warren Buffett. He's a big time value investor guy, and his Warren Buffett was Ben Graham's protege. And Ben Graham's known as the father of value investing. He wrote a book, The Intelligent Investor, where he outlines some things such as PB ratio. And basically the strategy behind that is you want to look for companies with a margin of safety, as he calls it, which is companies with PB ratios less than 1.5. And if you can even get it below 1, that's even better, because then you're basically getting companies that are trading, if they're trading less than book, you're basically getting a bargain for their assets. So for example, if the PB is 0.9, then you're paying 90 cents for every dollar of assets. So really that's a great deal. You can really get some stocks at a bargain when they're at that type of PB ratio, and it can be really beneficial to you as an investor, and you can see some really great gains. So to show you how to calculate PB ratio so you can kind of know how to calculate it in the future, this is an article from my website that I published a while back. It's part of my guide, the free guide I've got on there, and I show you how to calculate PB. Basically, you want to take the market cap and divide it by the book value. Book value is total assets minus total liabilities, and you can find that information on the company's annual reports, which I did here. For this example, let's look at Apple. You can see total assets are 176 billion, and total liabilities 57. So if you subtract liabilities from assets, you get what's also called shareholders' equity, or book value, at 118. Now that we have that number, we take their market cap number, which is right here, 427.3 billion at the time that I wrote this article, and divide by book value 118, and you get 3.6. So if you remember talking about the PB with Ben Graham, if it's under 1.5, that's good. You usually want to keep it around there. So at 3.6, that's actually quite overvalued, and so therefore you can kind of deduce that Apple might not be a great buy at this time. Now I'm going to show you two examples of the price to book ratio. We're going to look at two companies in the same industry. They're both leaders in their industry. Compare their book value, see which one is more undervalued and might be a better buy. Now, this isn't a recommendation to buy stocks. You should do all your own research. This is just for teaching purposes. I'm going to show you how to do this. So the two companies we're going to look at are Electronic Arts, EA, and Activision Blizzard, ATVI, both video game stocks, and one of them actually has a pretty attractive PB ratio right now, and we're going to look at them and just compare them. So in order to calculate PB, we need to get their market cap information. So if you just look at Yahoo Finance, we can find market cap. We see here it's 7.15 billion. I made a calculator just like I did with the previous video with PE ratio, and this one will calculate everything for us, make it nice and easy. You also get access to this if you want by subscribing to my email list, which I will put this up on my website, make that available to my subscribers. It's a free subscription for now, so I really recommend people take advantage if they're interested. So look at EA, and again, their market cap was $7.15 billion. You can see I put some of the other top stocks, and I have their PB ratio there for you, so you can kind of compare based off that. You can see right now with the stock market climbing new highs every day that the PB ratios for these are all pretty high, and none of them really look very attractive based on PB ratio, which, if you think about it, with how high stocks have gone up, it does make sense. So now we have the market cap. We want to get the total assets, total liabilities, and book value. Now you can use Yahoo Finance, but actually I've found that that's not very accurate and reliable. And I've seen actually errors with the income statement, balance statement, cash flow. I've seen errors before because it's not regulated. And so there can be errors, and there's really nothing you can do about it. So if you want reliable information, you want the right information, you want to go to this website, FCCgov, and I link to it on my website under the resources tab. But this is where the companies they are required to submit their annual reports and quarterly reports and other forms to the government, and it's all available for all of us to look at. It's free public information, so you should really take advantage of that. So I'm going to show you how to get the PB ratio from these forms. So let's look for the company EA. That's their ticker. I'm going to go over here, the filing type, and go 10K. 10K is the annual report. And we're going to look for the most recent filed annual report, which is this guy. Now, there's a lot of data that's on these things, so it can be a little bit overwhelming. But if you follow my steps and just pay attention right now, you'll see that it's not that hard. Now, what we want to look for is the consolidated balance sheet, because they have numbers on there, but if it's not the consolidated numbers, those aren't the one, then you might be looking at numbers that actually are wrong. So computer just froze. So, sorry about the slowness here. Quit the software update. Of course, it would pop up while I'm recording, right? Okay. So here we go, consolidated balance sheets. And this is where the information is that you want to look at. And I've made it easy. If you just look at the calculator that I made, it'll show you exactly what you're looking for. So we're looking for total assets. Look for the most recent year, which is here. So we got this number. We'll put it in, copy it, put it into my calculator here. Now we want, I made the calculator automatically calculate liabilities based off assets and book value. So all you need to do is put assets and put book value, and it'll subtract assets from book value and give you the total liabilities number. So we look for book value, which is also a number called stockholders equity or shareholders equity. So here's that number here, 2267, and we should see total liabilities of 2803 on the calculator, which we do. And based on these numbers, it took market cap divided by book value, and we got PB ratio 3.15. Again, that's a little bit high. The stock at this valuation is overvalued, and so it's probably not a good idea to invest in this company at this time. But let's compare it to its competitor, ATIV. And let's see if we see anything different. Or, I'm sorry, ATVI. So, let's look for market cap first. Again, we'll use Yahoo Finance for just the market cap. And we see 16.46 billion. I got these numbers here in millions, so that's why you see the numbers like this. And let's get our assets and book value numbers. While I'm doing this, I gotta tell you, this is the second, or it's probably the fifth time I'm recording this. I happen to do a couple of takes, just got to get my thoughts straight and everything. But I went through the whole spiel, and turns out, it was about 18 minutes, and then I sat down and listened to my recording, and I forgot to turn on my mic. So I went through this whole spiel once before already. A little bit frustrating, but hey, that makes it better for everyone else, right? That way I've had more practice with this little lecture about PB ratio. Anyways, okay, total assets here we see 14.2 billion. So let's plug that in. And then shareholders equity here, wow. So 11.3, really, they don't have a lot of liabilities at all, which is great to see when you're investing. So with that kind of a book value, you see a PB ratio of only 1.45. Again, that's much better than what we saw with EA, and it is under the 1.5 criteria. So you can see that at this time, Activision does look undervalued and could be an attractive option for our next investment. So I hope that helps kind of give you an understanding of PB ratio. I got one last quick example for you while I'm still on here recording. I'm going to show you General Electric, which is one of the top market cap companies of late. And you can see I've taken all their information all the way back to 1991. And I do this with a lot of companies I'm researching, and it does take me a lot of time, but it gives me a great picture of what's going on and gives me better insight on whether stocks are good buys or not. So what I've done here, I put this in bold, their PB ratio, and we're just looking at like quarter one. I do have information for all 4 quarters, but just for simplicity's sake, let's just look at quarter one. We're looking at market cap and price to book ratio. So you can see here the company was growing, and PB was kind of average for a while. It's actually pretty high, but you can see as it gets higher, like around this area, you see huge PB ratio. I mean, 10.6, 10.5, 7.6. This company is extremely overvalued at this point, almost to the point of like a bubble, and people are just throwing their money in without even thinking. And you can see like here in this year, which is 1999, the market cap's at 450 billion, goes up to 532 billion, but all good things must come to an end. And when a stock is this highly overvalued, it's going to come crashing down. And you can see the next years after, when it reaches its peak here at 532, it just crashes down. We go down to 416 the next year, 379 the next year, 246 the next year. So shareholders who bought in at these prices are just getting killed. And someone who bought in here saw their money dip down in half by the time it went back to a normal, like around 3 PB ratio, which, remember, like I said, that's not even a great spot to buy, but it's more average than something like 7, 10, stuff like that. So you can see that if you were smart at the time, even though it was during the dot-com boom of 1999 and 2000, a lot of people were greedy and throwing their money in. But if you were a smart investor and you stuck with the basics, you remembered the fundamentals, we're talking about ratios that have been around for a long time and have been proven to have worked, you would have seen a PB of 10.5 and you would have been like, what? No way. I am not putting my money in this company. And you would have been right, and you would have been saved from a lot of heartache, because people here putting in a lot of money at these valuations saw in 3 years' time their money went from, let's say, 100 down to like 50. They lost about half their investment there. But I showed this as a good example because, it's not about one stock's better than the other. It's really stock prices fluctuate. And so even a company that's great might be a bad time to buy because the price to book is really high. But if the price to book gets low, then it's an even better time to buy. It's more about, I don't want to say it's more about when you buy, but it is true that if you're using price to book ratio, you want to look for the low ratio, buy in when the ratio is low, and really avoid the stocks when the ratio is high. And so we're looking at the same company, and if you look over here, the PB got as low as 1.0. Now, if you're a value investor, you see a PB like that, and you really want to take advantage of that. So you invest money, and you see at that time the market cap was down to 122. And if you're investing money at that time, then even within a couple of years, you saw your money almost double because you were buying when the company was at low valuations, and so you're rewarded big time. So I hope this example helps kind of give you a better picture. I'm not even saying I like the company GE. I don't even like them for other reasons other than PB ratio. But you can see even with a company I didn't like, if you're using PB ratio the right way and you're calculating it and figuring out, using it to help you with your stock selection, then you can see how it would have helped you to avoid some big losses and even get some big gains without any other type of rigorous analysis. Now, you should use price to book in combination with other ratios, and I go through all that in my book, which is free, available on my website. You just give me subscribe to my email list, and you get access to both my PB calculator and the book I wrote, which shows you 7 steps. You use those 7 categories and you start investing, and you'll be fine. It's a very conservative strategy, but it makes you money in the long run. It's not going to make you money overnight, but over time, it's something that it's just fundamental. It's the basics, and it's practical. It works, and that's basically what the analysis is based on. Now, if you want one last example, I actually have a real life example in my book, which let me just scroll up to it here just for a second. I have this example right here, page 28 of my book. I'm not going to show you because it's for my subscribers only. Again, it's free. But in that section, I show you example between Apple and Barnes & Noble in 2012. And I show you the two different the PB ratios that they had at that time, and I compare which one was better buy at that time. And then when we see the results of today and see actually one of them lost 20% and one of them gained about 15%. And the numbers actually the results might surprise you, but it's another great example of how price to book ratio can help us out in our investing decisions. So I hope this little lecture helped. Again, if you want more resources and you want to see these examples that I've laid out in my book, go ahead and subscribe on my website to my email list. I don't sell anything on my email list, and really it's just the best way that I can communicate with the people who are interested in what I'm interested in, and I can also give you guys value through that. So I hope you enjoyed this, and thanks for listening if you did listen all the way to the end. And as always, I wish you the best of luck in your investing journey. Thanks.